Hey everybody, I'm Dave Townsend, a realtor here in Middle Tennessee. The big news this week has been talk about a 50-year mortgage. Now, we're used to thinking about 30-year mortgages, we're used to talking about 15-year mortgages, but a 50-year mortgage, that's a very long mortgage. Now, the reason for this, President Trump has proposed this in order to create a more affordable option for housing so that your payment amount can be a little bit less because it's spread over a longer period of time. But does that actually work out, and is it really something that people should be looking into? Well, that's what we're going to talk about today. I've put together a spreadsheet because I love spreadsheets, and we can go through and you can see the differences between each of those mortgages, the 30-year, the 15-year, and the 50-year. You can compare them on the same page. And I'll actually include a link to where you can download this spreadsheet for free. You won't have to sign up for anything. You just can go and download it, save it onto your computer, and you can play with it as you want to and put in different options from it. So let's go ahead and take a look at that. Let me show you how this actually works out, if it's any better, or how much worse it might actually be. Okay, let's take a look at the spreadsheet so I can show you how this all works out. If you start with an initial balance of $400,000 and a 6% rate, I took the $400,000 based from our local area. We've got some houses that are kind of starter homes that are a little less than that, somewhere in the mid threes, and then a little more than that, somewhere in the mid fours. So I think $400,000 is probably good for this exercise here. The rates are changing every day. Sometimes they're down around 6, sometimes they're 6.25, so we're just going to go with an even number on this one. Hopefully they'll be down in the 5s at some point and it'll be a better situation for everybody. But looking at this page here, we're using those two as our baseline, and then I've got the 50-year term in yellow, the 30-year term in green, and then the 15-year term in this little periwinkle blue color. The big difference that you'll notice right off the bat, the payment amount. Okay, with the monthly payment, you've got $2,105.62 for the 50-year mortgage. 30-year mortgage is $2,398.20. Now the difference between those is this right here, $292.58 is the difference between those two payment amounts. That's almost $300, which can cover a lot of things. Now keep in mind, none of this includes anything else like taxes, insurance. We're just talking about the basic loan amount. Now the 15-year rate is obviously a lot higher, but that's because you're putting a lot more down in principal payments each month. So it's got $3,375, which is almost $1,000 more than the 30-year, but that $1,000 is going to your principal, which means you're going to pay off your loan a lot faster. But not everybody can do that. It all depends on your financial situation. So looking over here, the big numbers that are really hitting me on this is the total cost. Check out this total amount of interest right here. That's just where I added up every payment's amount of interest and put it all together, $863,371.51. That is a lot of money. Now compare that to the initial balance that we had of $400,000. That is well over twice that amount. That's very significant. And so your total cost, when you add those numbers together, comes to $1,263,371.51. That is a lot of money over the life of a 50-year loan. Now, if you look over here on the 30-year, you can see how that compares. You're paying about $400,000 less in interest on that 30-year loan. That's a lot better over the life of the loan. Now, your total cost is still crazy high at $863,000, $352.76. So it is still a lot of money, but you can tell here there's a big difference between these two. The 30-year versus the 50-year loan is huge. You're paying an extra $400,000. That is another house in addition to it. So basically your interest on a 50-year loan, your interest and total cost together, you could pay for 3 houses of the same kind for that same amount if you were a cash buyer. Now most people are not going to keep a 50-year mortgage forever. They will either sell the house and move to another one, or they'll refinance somewhere along the way. So this is kind of a temporary situation, but what you're hoping to do with a loan like this is that you're going to be building more principal, paying down that principal so you can build more equity, and then apply that equity to your next home or your refinance. So the problem is the 50-year loan isn't very significant with that. So if we go 7 years down the road, I think 7 to 10 years is about average for people to move to the next home. So we'll base it off of that. And we'll come over here to the principal amount. So 7 years is going to be 84 months. We'll just scroll down the page and highlight 84 pay periods right there. And look down here at the bottom right corner of my spreadsheet. You see the sum is $10,992.20. So just under $11,000. So right there. If we compare the same period, and we'll come right over here to the same amount on a 30-year start, and we'll backtrack all the way up the page to the principal, $41,442. That is a $30,000 difference over 7 years. That's $30,000 more that you could apply to your next house or to that refinance if that's what you're doing in 7 years. So you can see you gain a whole lot more by paying just a little bit more, the $292 extra per month. Now if we want to really contrast that with the 15-year mortgage, look over here at the principal. We'll go down 84 pay periods. Down the page, I went way past that. Let's go back right here. And that puts you at $143,146 toward it. So, that's $100,000 more that you've gotten toward your equity on the 15-year than on the 30-year. So it is a much better way to pay it down. Now that may not be your goal. I mean, you may be using some of the extra money that you're saving on the payment to go into retirement funds, different things like that. So, every situation is different, and what I'm telling you is not the be-all, end-all. You need to examine your situation, kind of figure it out the best way possible for you. So my best advice here in this situation is to avoid the 50-year loan if at all possible. The 30-year is a much better product because you're paying a lot more down every month on the principal, and you're going to end up paying a lot less interest. It's still a boatload of interest over the long-term loan. So I highly recommend making extra payments along the way. You can either do that through making an extra payment every year. Maybe you're doing bi-monthly payments where you pay at the beginning of the month and the middle of the month, and then you kind of end up paying extra payments throughout that year because of that. The other thing you can do is just pay more money each month directly toward the principal, which then will reduce your length of term as you go. You could actually treat your 30-year loan like a 15-year if you're in that situation, and then it gives you that flexibility. If 1 month your money's a little tight, you could hold off on that extra payment, use that money, and then resume the extra payments the following month. So there's a lot more options that I think you would have there on that 15-year. Now that being said, every one of those things I just said could be applied to that 50-year as well to help your situation in that regard and pay more down each month on the principal. I just think starting off, the 30-year loan is going to be a much better product overall. So I would just recommend avoiding that 50-year one. So don't forget, in the description there will be a link to my website where you can download this spreadsheet. It's going to be free. You're not going to have to sign up for anything. You just right-click, save as, and put it on your computer, and you'll be good to go. You can go through it. You can fiddle with it a little bit, put in a different loan amount, different rates, and it'll calculate everything immediately. So I would recommend don't change anything with the amortization at the bottom, but you can mess with those first couple fields up there, the 400,000 and where the 6% was that we did earlier. So if you have any questions about anything, feel free to drop in the comments or reach out to me if you need help with real estate here in the Middle Tennessee area. Thanks for watching, and we'll catch you next time.